Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Some of the big questions that investors are asking themselves at the moment is just how well is the U.S. economy performing, and what will the economy look like once we are free of COVID-19, or at least free of restrictions that the pandemic has imposed on us. COVID-19 and the government response to the crisis have distorted the economy, that much is obvious, and we can see that very clearly in a chart of U.S. unemployment, which has been gently trending lower for much of the last decade, having peaked at 10% back in 2010. The lockdown that COVID necessitated in 2020 pushed unemployment upward in a straight line from just 3.5% recorded in February 2020 to a peak of 14.8% in April that year. The rate has fallen sharply over the last year as employers adjusted their working practices and reopened for business, as we all got used to the new normal. However, despite a bigger than anticipated fall in unemployment during May to 5.8%, the rate is still running well ahead of those February 2020 lows. The employment picture is further clouded by a sharp rise in job vacancies. This data lags the unemployment rate by 2 months, so the latest figures we have are for March 2021, when there were 8.237 million vacancies in the USA, whilst the number of unemployed people in the country stood at 9.316 million as of the end of May. The fact that those two numbers exist in tandem suggests that there is either a skills gap in the workforce, i.e. the jobs available don't match the existing skill sets of workers looking for jobs, and/or that the workforce and jobs available to them are located in different parts of the country. Mismatches such as these are described as the immobility of labor by economists, and they are not good news for either job seekers or employers with vacancies to fill. In the past, we might have expected workers to retrain and/or to move to areas where there are jobs to fill, but of course, both of those things have been made much more difficult under COVID. Another area of concern for investors is inflation or rising prices. Measuring rates of inflation and their effects on the economy is one of the key functions of the Federal Reserve, as the rate of inflation and changes within it can feed directly into monetary policy decisions about interest rates and asset purchases, or QE. Markets had a wobble earlier this year as 10-year government bond yields began to rise steadily, implying that U.S. government borrowing costs and overall interest rates were going to move higher in the near term to fend off the threat that inflation presents. Inflation can be thought of as a measure of the level of excess demand within an economy. Some degree of demand within an economy is healthy, as long as the supply side of the economy can catch up with that excess demand. And as it does so, we get economic growth. However, if the supply side can't catch up quickly enough, then we start to see and experience shortages and breaks within the supply chain. And that means the prices of end goods and services start to rise sharply in the face of excess demand. Some parts of the economy have already experienced these supply chain issues. For example, lumber and copper prices have been driven higher by excess demand, which in turn has pushed up construction costs and the price of new homes. While shortages of silicon chips, which are essential components in many of today's vehicles, has led to reduced production and supply of new cars. In turn, this has meant that prices for second-hand cars have jumped sharply. Used car prices in the U.S. rose by 10% in April alone, and by 21% when compared to prices seen in April 2020. These are the kind of pricing measures that have helped to push core inflation in the U.S. up as high as 3% in April, a rate that's far above levels of inflation seen in the U.S. over the last decade. The threat from inflation isn't just confined to consumers or just a few industry sectors. Businesses across the country are seeing their costs rise. Producer prices, or factory gate inflation, as it's often referred to, have risen sharply as a result. We can see that in this 5-year chart of PPI data. The Fed believes that this pricing pressure is transitory, meaning that it is just the growing pains of an economy that's reopening after a period of hibernation, and that pent-up demand has caused the imbalances. The Fed's logic is that 6 months down the line, this excess demand and shortage of supply will die down, and therefore there's no need to rush to raise interest rates. What investors need to decide now is whether these sharp swings in economic data are just one-off effects in a very special situation, or if they are part of longer-term trends that will be with us long after COVID. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions.